In this video, I would like to share with you the top mistakes that I've seen real estate investors make. I don't want you to fall for these mistakes. They're very, very costly and can cost you your entire real estate portfolio sometimes. The top one is about making the wrong assumptions about real estate financing. For example, somebody may take a construction loan to add a unit to their portfolio or to build a unit on an existing site, and they may assume that once the project is complete, they'll be able to go to a bank and refinance and get the majority of their money out and pay off that construction loan, and the property should cash flow. Well, here's what I can tell you guys. I've seen so many portfolios, and that's not always the case. The assumptions you make about money and financing are crucial to your success. And going into a deal, what you want to do is you want to sit down with an income property financing advisor to validate these assumptions for you, because everybody's situation is unique. There are situations where you will not be able to go to a bank and get an 80% loan at a 30-year amortization with an attractive interest rate. Why? Because maybe it's about the way you report your income. Maybe the number of properties in your portfolio have reached the ceiling. Maybe the property location is something the bank or the lender doesn't like. Maybe you are earning your income from sources that the bank wouldn't fully consider. So I invite you to validate your assumptions before you enter a deal. That will make or break the performance of your asset, and you don't want to put yourself in a tough spot. I've also seen investors take private money to acquire a property, and there is a reason to why you can only get private money on certain things. And sometimes the asset you're buying, like if you're buying, let's say, a rooming house, no lender would want to touch that rooming house. And there is a reason to why private money would be your only way. So yeah, it's great that you've acquired the asset. It's great that you have been able to finance it using private money, and it's probably cash flowing because it's a rooming house. But fast forward a year out, that private lender would want their money out. How are you going to pay them off? If you had thought about exiting the deal before entering the deal, you would have avoided a situation where the private lender wants out and you can't place that deal somewhere else. So it's so important, guys, to validate all of these assumptions up front. The art of building wealth in real estate is about how you're going to manage the risk in your portfolio, and that includes debt risk, which is the money risk. That includes interest rates, the loans you have, the loan to values on these loans, and obviously manage the revenue risk, which is the continuity of the rental income coming through and any risk associated with the discontinuation of that rental income. So validate your assumptions up front. Take the time to do it. Do not just get excited about acquiring the property and dealing with that later on. Second mistake that I see investors do is that they get so excited about acquiring the property and wanting to acquire that property with the least amount down. So that's where creative financing may come in. And believe me, we've done deals using creative financing where a client may have gotten a private first mortgage and a vendor take back second, and they had, the least amount of capital into the deal. But again, the art is not in acquiring the asset. The art is in figuring out how you're going to pay the money back if you have financed a deal with 100% loan to value or a high loan to value. How are you going to pay that money back? What's your strategy? These are typically temporary loans that need to get paid back eventually. So we have to talk about your plan for either increasing the net operating income of the property or renovating it and adding value, and what are the assumptions that need to fall in place fast forward 12 months from now or in the future to make sure that we pay that vendor take back or pay that private mortgage back. So again, creative financing is great and it actually works, but you have to be a forward thinker and think about how you're going to pay that money back. The third mistake that I've seen, especially in this past cycle of 2023 and 2024, is the risk of what I call over leverage. What's over leverage? Over leverage is when you take a very high loan to value debt on one or more properties in your portfolio. And again, there are loans out there, private loans, that will give you a 90% loan to value to acquire something. I hear about promissory notes that investors source to maybe fund renovations. These are unsecured loans. And I get concerned when I see a real estate portfolio that is sitting in a very high leverage position on multiple properties over an extended period of time. Because when the markets change, values shift, lenders want out, or lenders may raise their prices because there is, less traditional loans available. And that puts incredible pressure on the portfolio. And if it's in a high leverage position, especially on multiple properties, that's when things fall apart. And sadly, I've seen portfolios fall apart. Some of them are very large portfolios in the 2023 cycle exactly for this reason. So if you decide to take a high leverage position on a property, you gotta be very intentional about how long you're gonna be in that high leverage position. Be intentional about what you're gonna do to exit that high leverage position, and also have a backup plan. But when you take a high leverage position on multiple properties and have promissory notes behind the scene, that is what I call over leverage. And you got to be very, very, very careful about doing that, because you're really putting a big piece of your portfolio at risk as a result. Other mistake that I see is investors not knowing their numbers. Nobody enjoys filing their taxes and sitting down and doing the tax paperwork for their accountant. I personally don't enjoy doing that. And because we don't enjoy it, we don't actually sit down and do it in time. So when you need numbers about your portfolio to make an informed decision about whether you should sell a piece of property or keep it, you want to have these numbers at your fingertip. Your books in a good shape. You want to have your numbers and metrics accessible to you and up to date. And I know this takes discipline, but there are times where I've seen investors unable to make an informed decision about their portfolio because they did not have these numbers at hand. Another mistake that I've seen is investors getting excited about owning as many doors as they can. In my view, that is the wrong thing to chase. I've seen thousands of portfolios, and I can tell you that an investor with 300 units is not necessarily better off than an investor with 20 units. At the end of the day, it's not the number of doors that you see on the surface. It is the bottom line on how that portfolio is performing and the risks that come with creating a larger portfolio. Folks, the debt structure on a portfolio makes or breaks the performance of your portfolio. I've seen smaller portfolios with an optimized debt structure that are highly profitable, generating cash flow, and investors are literally retired on these smaller portfolios and their life is not as complicated. And I've seen very large portfolios with hundreds of doors, with leverage all over the place, and lack of discipline in managing the fundamentals of the portfolio, like the revenue, the tenants, the accounting, the loans. So they're really built on a foundation of sand, and therefore they're significantly underperforming and in fact at risk of falling apart at any economic downturn which I have seen. So folks, do not chase number of doors, chase an optimized portfolio. When you buy properties, you want to make sure that you've got your processes in place, you want to have your team in place, you want to make sure that as you acquire properties, they're cash flowing, are planning how you're going to manage the loans, how you're going to manage the debt. You are stress testing your portfolio with respect to interest rates, you're stress testing it with respect to assumptions that you're making. Focus on that, and then the wealth and the cash flow will come. It's not about the maximum number of doors that you can own. I'm not against owning hundreds of doors. All I'm saying is build the right foundation, focus on the right fundamentals of cash flowing and managing risk, and then you can go up a lot faster than just trying to go up fast without managing these fundamentals. So these are the key mistakes I see, guys. If you are in a tough spot because of any of these things, we are here to support you. We're here to help you resolve any challenges you're experiencing and to come on the other side. Reach out to our team at info@streetwisemortgages.com.